Brynne, welcome back to F.A.C.E. What a great time to have you on. So I'm going to see if I'm going to unmute you, Brynne, and you'll have, there you are.
Hello, good morning.
Good morning, Brynne. It's been a while. Welcome back to F.A.C.E.
Thank you. Yeah, it has been a while, actually.
Do you want to share your screen?
Sure.
Okay,
Sure.
so you just hover your mouse over that area and it'll give you a screen to share.
Does that look like it's sharing?
Yeah, it's sharing. Okay,
all right.
Henry.
Well,
Henry
you know me,
Hub.
I'm more about fixed charts versus, all you guys have all your live stuff with all your technical analysis all over it.
Yeah, and it's interesting. I really want to talk about this, but can we first start with you as a trader, Brynne? I want to pose the same question to you that I did to Steve, because a lot of people do trade energy. So let me ask you this. Are you hesitant in this current geo environment, even if you're bearish and you see a reason to play the short side of crude, to do so, knowing that, we were only a minute or so away from a strike last Thursday?
Yeah, I mean, for me, I guess I look at it a little bit more micro than these big macro issues, because those a lot of times can come down to momentum and groupthink, right? On if one of these events occurs, because unless realistically you see the spot price of a commodity run up, in a lot of ways these macro events, aren't, they're just noise. So
you think that this could just be noise? What's happening? What could happen in the Straits of Hormuz?
Well,
to me, if it's noise, it's very loud noise.
Yeah, I guess I'd see either the Brent WTI spread widening out.
Okay.
If that were
a concern by
something
the
that so obviously it hasn't happened, right?
Right.
And so it's a fear or a concern, and maybe that would be a more interesting way to play it than just in the outright, because right now the story in the US is about infrastructure, right? And if we could, with a $7-8 Brent WTI spread, if you could export as much as you wanted, they would. And that spread would come in, right?
Right.
But we only have a fixed amount of infrastructure. There is a ton of things on the docket over the next couple of years. They're even dredging the Port of Corpus Christi so that they can handle the very large, the VLCCs, right? The Supermaxes.
Wow.
There's pipelines that are coming online, additional ones to get that crude out of the Permian. So to the extent right now, anything were really to happen in the Straits of Hormuz or any of these things that you're looking at, other markets have faster access, and in that way, that's why I would see this spread widening out. But absent that, we've seen that spread. Actually, I think it came in like 75 cents yesterday, the front spread, and that doesn't really suggest strength in the market, right?
So there's still a lot of complacency about it. There's nothing in the market that, even though people might have it in the back of their mind, prices aren't reflecting any stress about what's happening there.
Not really. I mean, we had the refinery problem on the East Coast, and they tried to get some traction on the gasoline cracks.
Right.
And even that kind of petered out a little bit. And I think that's going to take a little bit longer to really expose if that's a real shortage that the market will have to contend with. So yeah, I mean, sure, there are a lot of upside risks, and that's why probably when those things are hanging out there, OPEC meetings and tariffs and conflict, I prefer to play it with spreads than with the outright.
So I want to learn with from you with our community today, and I bet there are a lot of people that trade crude that never even heard of Henry Hub daily cash prices. So why don't you tell us what you have on your screen, and that rectangle black box there, it's like a period of huge stability and prices coming together. So what do we have here, Brynne?
Yeah, there's a little method to this madness here. I mean, I am going to link us all back to crude oil here. So
okay.
Don't worry about that. But I come at the I always seem to come at analysis or the way I view the markets in a little bit different way than kind of just
us technical analysts.
Yeah, which okay. I mean, look, I think I've told this story before, but way starting out my career, I remember I worked at Dane Rauscher in Minneapolis, and okay. I mean, I didn't know anything about any of this, and they had some corporate meeting where the analyst group was presenting internally, and they did that fundamental group against the technical group, and they had a competition and had for the last year or something, and it was just a flat out draw, right? I mean, neither one is better unless it's better for your style of trading.
Okay.
So anyway,
okay, you know what? That brings up a great question, because I've interviewed Schwager, and he talks about the difference between it. And he says the major shortcoming of a strictly fundamental view of a market is that if the fundamentals are good at a point and prices keep declining, say it's, bullish view, then prices are even better. And whereas a fundamentalist is your stop to control the risk of a fundamental idea.
Well, and a lot of that comes down to, the length of time that you're holding a trade and your VAR, right? Or your capital risk. So, I mean, certainly even if you're executing something in a short term on a technical signal, you always have a stop, right, under which you would get out, and it's no different, right? If you're building sort of a fundamental picture and putting a trade on with the expectation that sometime within the next 3 months, for example, it will mean revert, let's say.
Okay.
And in a lot of cases, especially in energy, it's spreads, either basis spreads or time spreads. And
so you're willing to risk, you're willing to take almost any kind of price risk.
Well, let's say your VAR is $1 million, right? Then you're going to get stopped out. It's no different. I mean, either it's a corporate VAR or risk limit, or it's your own personal one. And and you set those for yourself when you're executing any kind of trade.
Okay.
So yeah, it doesn't really just because it's fundamental doesn't mean that you're pig-headed, right?
Okay. Yeah.
It just means
that's a great explanation.
Especially when you're employing a lot of capital, massive capital employment in positions in commodities on a longer dated basis is certainly expecting that they didn't get in at the right time, and that there's going to be some level of
drawdown,
P&L swing before you hit your target, and also a point at which you find out something's changed, right? And you have to get out.
Okay. All right. So what are you seeing here?
Well, so, obviously natural gas is just a very boring commodity in the summer. So I don't really want to spend a lot of time on that per se, except for to build the overall kind of Permian picture between oil and gas. And so I like to start with this chart because you can kind of see, you're right, I have this box where over, since the shale revolution, prices have just really stabilized in the summer in a pretty tight range. And most of that is due to the fact that, natural gas is has 2 seasons, right? Summer, which is April through October, and winter, which is November through March. And in the summer season, we're injecting gas into storage. And so there really aren't any days where you're actually short gas. It might be that you have less on any given day to inject into storage, but it's not like the winter when you're withdrawing for storage and there is actual price chasing, in need of a molecule that minute.
Okay.
And so it's hard to get, prices to really move outside of a range, even with like hot weather, unless you're talking regionally. And
so you leave it alone until the winter season, and that's when you become a natural gas trader? Leave it alone the rest of the year?
Well, what most natural gas traders spend the summer doing is putting on winter spreads, right? So at times when flat price gets pretty low, you start to look, spreads that usually blow out in the winter. And let's just take like Feb, March, for example, the spread between Feb and March. I think last winter it ran up to like 38 cents before it ended up settling maybe like flat, or I'll have to go back and look. And that's, when that gets on people's radar, those are the types of spreads that start to run. And that may happen in September, it might happen, in October. And so you just kind of look to pick up some of those types of spreads cheaper in the summer. And then also, for the last...
You buy straw hats in the winter.
Well said. There you go.
That. Okay. Interesting. Okay.
Yeah. And then short of that, obviously it's such little ranges in the summer that's a pretty easy, thing to day trade. It's just, you're not going to, get very rich, right?
What were your expectations on ranges during that time frame?
Well, so if you take a look at where we're at now here, right? The red line is 2019 cash. And, so far we've had a tough time trying to, coast on into this range as we have in previous years. And I'll talk about why that is. But typically after the 4th of July is when there might be a turn to the upside. You have, and this year especially, I think 4th of July is on a Thursday. So you're going to have, Thursday, companies are going to be closed. Friday, especially when you look at a lot of factories and stuff like that, they'll do a 4-day weekend. And you just end up with less demand.
How about us, Brynne? Did we get Friday off?
No.
No? Oh, gosh.
Well, you can take it off.
All right. Okay.
All right. So that's kind of, sitting here with this, bumbling around here on the bottom. Nobody gets really natural gas has a hard time gaining much momentum to the downside at these levels for a couple reasons. One is that, so this is, what we looked at here was just Henry Hub, the daily spot price.
Right.
But if we go over to this chart, the black line here is now Henry Hub, the daily prices, and all these other colored lines are all various, trading hubs around the country, right? Because Henry Hub isn't really the story. The story is under the hood and all the regional dynamics. Okay. And so you can see if you get yourself away from Henry Hub, you can see the type of volatility that we have going on day to day across the other markets. And they're all a reflection of the local supply demand dynamics. Okay. It's either a producing area or, a consuming area and restricted by pipeline capacity generally.
Okay,
and that's really...
the one in Florida is the most volatile or all over the place. Is that thinner? Not as big to have the kind of swings? I'm looking at the turquoise line.
Oh, so that's East Texas. That's the Permian.
Okay.
So that's Permian production. And so that's exactly where the focal point is right now in both gas and oil. So this light pink line up here is sort of the Marcellus area, the light pink and the bright green, which are almost flat to each other. And several years ago, those two hubs were swinging wildly and pricing negative, like we see this aqua line, until they got enough pipeline capacity to take away to get it out of the region and move it all down to the Gulf Coast.
Okay, so it's more of it being kind of embryonic and not having the infrastructure yet.
Exactly. So now you
Okay.
have this Permian area, right, that is an oil play. So realistically, you know, what they're, you know, the producers are drilling for oil in you know, West Texas. But for every barrel of oil that comes out of the ground, like 30% of that is associated gas.
Okay.
So as a result, they're, you know, without even being a natural gas producer, we're producing all of this natural gas in West Texas. And, you know, you can kind of see the schematic behind the scenes here, the pipeline infrastructure. There really isn't much to speak of to go directly from West Texas to the Gulf Coast. You have to kind of go around the horn. There's not enough capacity. And as a result, it really gets stranded in region. And literally, it's not even part of the economics for these oil producers. And so dumping this gas at F.A.C.E, you know, is a nuisance at best. And realistically, what they're doing with a lot of it in the Bakken and in the Permian is they're flaring it. You know, so
which is what, burning it off?
Just burning it, just
okay,
burning it, you know, just to get rid of it, right?
They bring
So right at the well.
Bring some marshmallows with them, or?
Yeah, right.
Okay.
Hopefully what they bring is, you know, like a waiver that they've gotten to do that. So,
Okay.
so, you know, there's, you know, some people are saying that it, you know, 2 BCF, 3 BCF a day, whatever.
It seems wasteful.
Yeah. I mean, you know, use it or lose it, and we're just losing it. So now we have this interesting situation going on. And I don't know if I can go to this. So does that share too? Do you see an oil? I don't know. Oh yeah, there we go. Please move it away. Can you see Permian spreads?
No.
Or do I have to share? Oh,
you have
new
to share again. Stop.
Oh, I have to do a new one. Okay.
Yeah, most likely.
Let's see. I didn't know it was going to be that complicated.
Yeah, there we go.
Okay, so essentially, what we have going on in the crude markets is we're awaiting pipelines, and they're awaiting pipelines out of the Permian to the Gulf Coast for both gas and for oil. And there is a huge pipeline coming on out of the Permian area down south, heads down south of Corpus Christi, called Gulf Coast Express. And it's a 2 BCF a day natural gas pipeline. And it's expected to come online in October. And so, you know, the market is somewhat, you know, is really trying to figure out what that means. And as a result of that kind of impending pipeline, all of the oil producers are given waivers. They're allowed to flare natural gas for longer. Normally it's 30 to 40 days after you drill the well that you're allowed an exemption to flare. Right. They're being extended and extended for, you know, it's for up to a year here in anticipation of this gas pipeline coming online. And you can almost look at that as it's been a bit of a cap on production in the Permian, because, you know, they want to produce more. You know, you can get oil out of a region a lot easier than you can get natural gas, right? Because at least you can stick oil on a truck, on a rail car or something. You know, natural gas, you'd have to liquefy it to do that. So as soon as that pipeline comes online, you know, you've got all this gas that's been flared that can now hit the pipeline, assuming there's processing capacity for it. And then it frees up, you know, producers that were being held back from that standpoint, right, of oil to be able to go drill for more. And you can see the dynamic playing out in both the Permian markets in oil and gas. This chart right here is the spread between Midland is West Texas, Permian, and then the Houston, WTI at Houston. And kind of starting the beginning of the year and moving all the way down to currently is the green line. So that spread has been coming in. And a lot of that is the result of, you have existing pipelines in the area that had tariff rates around 4 and above. And now these new pipelines have different tariff structures.
Really reduced.
Right. So just at that, you just have, so let's say the oil that could now ship on these pipelines for $1.30. And I mean, I know I'm simplifying it and people can say, well, there's a lot of other little nuances, but, their alternative was, rail, truck, which, is $10 or, an extremely, proportionate, much more expensive, means of getting it out there. So now all of a sudden you have this oil delivered to the Gulf Coast at a cheaper landed price. Let's put it that way. And so you can see that playing out in the spread here. And it's ultimately pushing itself through to the WTI Brent spread. And I think I have that. Let's see. Well, not in this one, but ultimately, and I think we saw that in the narrowing of it somewhat, is that now you have cheaper landed Gulf Coast crude oil, meaning, it's a cheaper product that can go overseas, and hence, at some level it filters through to the Brent WTI spread. So many things are originating from this Permian area from a logistics standpoint. And let me go to this other screen here and you can see the same thing. Let's see. In natural gas. Let's see, did that?
Okay. Yeah, it came up.
Okay. So, you look at this same area here in natural gas. This is the Waha region. So, Midland and Permian, Waha, kind of all the same area. The red is existing kind of pipeline paths coming out, and the blue are proposed. This bottom blue line is the Gulf Coast Express that's supposed to come on in October of this year. And then we have a big one coming on, the expectation is October of the following year. And you can translate that back to the futures curve here. So this is Waha futures, right? And you can, right now, I mean, for the month of August, it's 6 to 10 cents for the outright commodity, right? That's what natural gas in West Texas is trading for. And as you get here, September and October, right, anticipation of line pack into some of those lines, you can see that the prices just significantly move up, right, and recover. I mean, now by January, you're getting a whole $2 for the gas.
Right.
But then the expectation is that oil production increases, overtakes, now you again have excess production over capacity, and we have to wait again till next October when you get the next pipeline that comes online and alleviates that bottleneck. And so we're constantly, trying to eliminate bottlenecks. But the thing to keep in mind about all of that is that just brings more product to markets. Removing a bottleneck is like step one. Step two is how much more supply there is.
Right.
And I would say
it's incentive to produce more. So the fact that there's a pipeline is kind of a bearish fundamental because there'll be more production. Is that? Yeah,
I mean, and that's where a lot of the bearishness comes from, is the exponential growth that we continue to see out of West Texas. We're getting closer. Last year we not as many of these pipelines were as imminent to completion, but this year there's a lot that will be put in service.
Yeah. And
especially in natural gas, it's like you had 2 BCF a day that was stranded or being flared in West Texas, and now you add this pipeline. So it's why people just are reluctant to buy natural gas, even though, I don't know, I mean, storage, it's kind of in the middle of the range. I suppose you could make we're not as full or we're full. But realistically, the expectation is, come October, things are going to look really different. You know, you bring
Is
these.
that a high conviction idea of yours to be accumulating natural gas, or at least a bullish, constructive positions this
No.
summer, Brynne?
No.
Okay, what is one of your higher conviction positions?
I will buy winter spreads.
Okay.
During the summer.
Okay.
So March, like I mentioned,
okay.
I don't really, the March-April spread is ridiculous. That's it's just some weird legacy thing that's happened. But, and then also.
Are they liquid this
Oh,
time
yeah.
of year? Okay.
Oh, yeah. Yeah.
All right.
And, you know, there's a lot. So right now the gas market, you know, July to August, Sep, and are backwardated. And, you know, that doesn't really entice a lot of gas to go in the ground. But if you look at like August to December spread, it's like 30 cents. And that's a pretty decent spread. So the problem, you know, in the summer is that people will, you know, put gas in the ground and they'll sell winter, which is why it kind of takes a long time. You know, you don't ever see winter start to rally until you get later into the fall, right? And that whole trade is put to bed. And so what I'm looking for is we have all of this supply coming, you know, towards, let's call it fourth quarter, end of third quarter and fourth quarter, in oil and in gas. Because
of new pipelines.
Because of new pipelines, right?
Oh, yeah.
So what you need on the other side of that, like the expectation is that this gas supply will go to new LNG plants. But the timing is not going to be exact. You know, they're not all going to come online at the same time. Some of these new Gulf Coast LNG terminals,
yeah,
as well as getting, you know, a lot of it is also expected to be exported to Mexico. And there's a lot of pipeline issues there. And so that's where all the eyes are, is logistically, can we get this product out of here? And the same thing in oil, right? Can we get all this Permian production out of here? And in oil, we talk about it's so light, you know, this shale production, you know, can, you know, refiners around the world really process it? You know, there've been a lot.
That's interesting. So it's easier to process a heavier crude than a light crude.
It's not that I wouldn't say, I mean, I don't know if that's the right word. I think it's, you know, a refiner is a complex algorithm, right? That's run to optimize the cheapest crude. And over time, you know, the cheapest crude historically was heavy crude. And so there are just so many refiners that were just sort of set up to process heavier crude.
Okay.
And so in a lot of ways, it's just a matter of that is capacity, another logistical, you know, timing thing, and definitely something to think about. You know, I read an article the other day where a lot of these Asian buyers of crude oil, they don't want WTI from Cushing, because if a barrel has gone through Cushing, the reputation is that it's been blended as it's gone through there, because it's either, you know, sketchier crude from, you know, some of the smaller wells, or from the Bakken area, crude that really needs to be blended in order to meet specs. And what they'd rather have is WTI Permian. Like, that's originally West Texas Intermediate, actually refers to crude oil produced out of West Texas.
Right.
And so
the Permian is, and
is West Texas. Yeah, and so there's been kind of, you know, this preference to make sure, you know, your crude is sourced from that region. Mm-hmm. And in that way, I think it's going to be interesting to see, you know, you see WTI is lagging behind the entire pack. Let's go back to my crude thing. I'll share this one. New share. And just stop me if we're running out of, I don't know how long we're supposed to be going for. So, here, let's just go to one. There we go. You can see there's Cushing is the black line here, Midland, which is the West Texas, and then Houston. And the dotted lines are just from, it's a month ago, right? So obviously the curves have shifted down, but, you know, prior to this last little bit of pipeline, because we had a couple that were put in service the last month or so, Midland was really bringing up the rear, but even that has moved as a premium to Cushing. So
No one wants
I never
Cushing.
like selling the cheapest seat in that's out there.
Right.
Because in that way, any sort of logistical problem, people are gonna, short the cheapest one out there, right?
Right.
And the same thing if you look at kind of the overall complex, right? You got your Brent curve, and then Oman, and then your LLS, which is, in the Gulf Coast in Louisiana, right? And then you got your Houston Gulf Coast, and then you got your kind of landlocked in Midland, and then Cushing. So, obviously Canadian crude is then like another $15 lower than this, but, do you want to be short the cheapest seat when that's going to be the supplier? If the theory is that, the production story is so bearish here in the US, but global spreads stay wide, then as long as we have the infrastructure to get the crude out, then it's fine. It's if you start to see these global spreads collapse. I think a few years ago, the Brent WTI spread was what, $2.50, $3. So there's certainly a lot of margin in that, and that just doesn't say weakness to me.
You open my eyes to what a complex universe it is, and the energy sector, and just covering these two products. And would you say that fracking has revolutionized the kind of analysis that you had to do before that revolution?
Well, I would say that it makes historical comparisons difficult.
Okay.
A lot of 5 years is about as far back as you can go.
Good point.
Just because you even think about how a hurricane impacts, these two, gas and oil now versus how they used to, right? Before, when it's all sitting out there in the Gulf, there's a lot more at risk.
Okay.
And now majority is inland.
Right. Interesting. I have a question from one of our attendees. So how can you trade that spread from Scott? They are tooled for heavy crude. It costs $1 million to retool. That's his question.
Was that two questions? The first one was, how can you trade that spread? And is that the, I'm assuming maybe Midland to Cushing, or
or probably the bull spreads that, I'm not sure exactly what it means.
Well, so, the interesting thing is, and this is what I think is kind of a shame, and it really boggles my mind that the structure is still like this. But, all of these, different basis locations in gas and in oil are screen traded on ICE. So, you get an ICE subscription, you have, your account, and you can, you point and click, right? Yeah. All of these. Now they're not screen traded on CME, right? Just the benchmarks. As well as so many of these spreads are done, through voice brokers over the counter.
Yes.
Just because there's some complexity to it, which, is not a barrier. As long as you have a clearing account, you can execute any of these spreads through a voice broker and have it submitted, through your clearing account. So, I almost sometimes wonder, like, do I need to go on an education tour of,
you do,
in this world of, so much electronic trading? It's almost like some things have gone by the wayside and seem unobtainable. Now, ICE is unobtainable in that if you want to have oil and gas access for trading, I think it's like $2,000 a month.
Wow.
And that's, how is that possible, right?
It's like having a Bloomberg.
Yeah, right. But it's literally just a trading screen, right?
Right.
It's just a proprietary, it's like logging on to their screen. Or I know there are several kind of other, let's just like interactive brokers, but what do we call those? futures houses,
Yeah, clearing member firms,
yeah, a platform,
FCMs.
right? That
Yeah.
will you can pay for ICE exchange access through them. But in a lot of them, they only allow ICE Europe and all of these spreads
It's
and
a
different.
racket to collect fees. Let's call it what it is.
Yeah, right. Well, and they're very private about, I mean, getting access to it. But that's why I say you can also.
You have to be Bobby Axelrod on Billions to get that platform. So,
yeah, right.
I
mean, it's a thing you have, obviously, because the contracts are bigger, right? The contract sizes and all of that. But so my thought on that, because of course I've worked for the big shops where we've had ICE and had everything, and that's all I knew, and that's all I traded. And then I've had prop shops where you literally just kind of have like the futures contracts, right? I've had voice brokers, and the thing is, I think just because you can't trade it, you can still take signals from the spreads.
Right.
And so for me, I don't, whether I'm executing it or I'm using those spreads as a signal to execute something else, right? Mm-hmm. You a lot of times see a movement in some of these location spreads long before you see something in an outright flat price. And so you can still access, the settlement prices and look at where some of these markets are going. And I guess I think I've probably am a broken record on this too. Like, I feel like if you're just looking, let's say, at WTI crude oil, and you don't look at any of these other, all the grades of jet fuel and HOGO spreads and cracks and different, oxygenated blend stocks and all of the different things that go under it, it would be like, and the only thing maybe you looked at was inventory report every week, and then to try to see where WTI is going. That would be like if you had a screen where you could see the S&P futures, but none of the 500 companies' stocks that make it up. And then the only piece of information you had every week was like, non-farm payrolls every week. And you're wondering, like, why isn't the market reacting to that? Yeah. Right? It's very similar thing. Crude oil is really the index, these benchmarks. And we saw that in that other chart I showed with natural gas, with all the other locations moving all over the place. I mean, those are the stocks, right? Those are the 500 stocks that make up the S&P, right? And in that case, it's NYMEX Henry Hub.
Right, or you're trading the Dow, but you don't look at you only look at IBM.
Yeah, or you don't have any of them, right? Yeah, you only have one, and it's like you didn't even know they existed. Okay. And so I always encourage, unless you're just if you're just technical trading, like, don't even listen to this stuff, right? It doesn't even matter to you. Right. But I find a lot of people, no matter what, they really are a hybrid, right? I mean, they're using technicals for, kind of intraday stuff, but they're watching fundamentals.
The fundamentals give people the bias, and the technicals give them the triggers.
There you go. Right. And so just, I don't kid myself that I know like all the technical, entry and exit points. And, you got to sort of dig in and know that, you might not be seeing the whole fundamental picture either. And just from the standpoint, like, you want to know what sectors are doing. These are sectors, right?
Yeah. Your background in this industry and analyzing and forecasting, I believe that you should consider training energy analysts because of your knowledge depth and your handle on the markets, and educating, like you were saying earlier, for people to know that these things are available would be a great service. And you know what? You're one of the most insightful energy analysts I've ever talked to. And I've talked to quite a few.
Well, I'll just keep that right up.
Yeah, I mean, really, you could be a great natural teacher, and you have to, I think, mentor some people so that you could duplicate what you already know and give people the chance to look at the markets the way you do. Just my extremely accurate and humble opinion.
Well, I appreciate it. Yeah, it's interesting. You sometimes just figure out how much you know when you're teaching someone, right? You didn't
Yeah.
realize you knew something so well, and then you
And then they end up knowing it even better than you. It's really,
yeah,
anyway,
yeah.
so Brynne, I hope you have a lot of success with these spreads you're putting on. I want to thank you for educating me and our audience, and I hope that pips gush down on you like an oil well that just finally hit pay dirt.
Good one. All right.
Okay.
Well, great. Thanks for having me. Long time no talk. Let's not wait
Yeah,
so
and
long.
you're forever, you're my trading warrior sister and one of the best oil analysts I've ever interviewed.
Well, thank you. All right. Well, have a great one, Dale.
All right, thank you, Brynne.
Yep.
All right, everyone, that's a wrap for Turnaround Tuesday. Don't just count your pips, count your blessings. We'll be back with you tomorrow. See you in the chat room. Adios. Thank you, Brynne.
Thanks. Thanks so much.